Join
This
us for the
conference
next
will now
edition
be recorded.
of Sterling Seacrest University. We've been doing these kinds of programs for several years now, and in this virtual world we live in, we're pleased to have a strong turnout today for this program. I would tell you that we try to keep these topics interesting and fresh and current, and so if anybody who's on the call today has an idea for a program that our folks would benefit from sharing, please drop a note to me or Katie at your convenience. We try to mix these things up and keep them relevant. Again, my name is Doug Reeder. I'm the chairman and a co-founding partner here at Sterling Seacrest. We're a multidiscipline commercial insurance agency with deep industry verticals in healthcare, construction, real estate, and hospitality, transportation, logistics, nonprofits, and private client risks. We also have a large benefits consulting practice, which is industry agnostic. We're very pleased today to have Stephen Bradshaw join us and a couple of his colleagues, Peter Strafopoulos and Chris Stevens from Bennett Thrasher, to talk to us today about contractor sales tax obligations, strategies, tips, and war stories, I'm sure, about preventing accurately reporting your sales taxes, which vary by state, and also, the prevention of off-balance sheet liabilities that you're unaware of when you sell a company that would arise from sales tax obligations that were improperly calculated. Stephen is a partner with Bennett Thrasher's state and local tax practice, providing state income and franchise tax consulting, compliance, ASC 740 sales and use tax consulting, state tax credit and incentives, unclaimed property, and other miscellaneous state tax services to clients of various sizes and legal entity types. Stephen has spoken at or been featured in the Atlanta Business Chronicle, Accounting Today, Thomson Reuters, Georgia Restaurant Association, Georgia Society of CPAs, and others. In addition, Stephen has developed particular expertise in conducting buy and sell side state tax due diligence, preparing companies for M&A deals, and has deep experience helping technology companies with sales tax nexus and taxability issues, obtaining voluntary disclosure agreements, and advising companies in becoming compliant prospectively. Stephen earned his Bachelor of Science in Accounting degree at the University of Tennessee and his Master's in Tax at Georgia State University. He's a CPA licensed in the state of Georgia, a member of the Georgia Society of Certified Public Accountants, and a member of the American Institute of Certified Public Accountants. Bennett Thrasher has been a longtime friend of our firm. They are currently ranked among the largest CPA firms in the United States. Bennett Thrasher is a premier provider of professional tax assurance, consulting, and wealth management services to both businesses and high net worth individuals. Since 1980, their integrity has earned their clients' trust, and their culture of supporting professional and personal growth has created a long-term dedicated team. Please welcome Stephen Bradshaw.
Thanks, Doug. Appreciate it. Yeah, and I was starting to say earlier, I'm the sort of one brave soul. I'm going to share my screen. If nothing else, so it's a little more entertaining for everyone here. I know for me, our family's kind of buckled down tight just during COVID right now, and so I'm at home and my kids are upstairs in virtual school right now, and I'm my wife's helping them, so it's a new world for sure, but definitely happy to be here. And I know I used to get, Peter, you probably thought this when I first joined, but I used to get a lot that I look much younger than I actually am. And had a funny story when, yeah, still do. Yeah. So, funny story there. When my wife and I first bought our house, we moved in, and within the first week or so, kind of a young high schooler kid came by, and I think he was trying to, sell lacrosse books or something. And when I opened the door, he asked if my mom or dad was home. So that was fun. So I guess I can thank my genes, as the years go on. So okay, cool. So yeah, thank you, Doug, for the intro. I wanted to introduce as well Peter and Chris. and really sort of let them introduce themselves. Peter and I, and really Chris and I, have worked together for a number of years, and Peter has just a wealth of experience and knowledge, and really all three of us have, as Doug said, war stories and I hope interesting kind of stories to share with you all on the sales tax side. So Peter, do you want to introduce yourself?
Yeah, so thanks, Stephen. I'll just say a few words. So like Stephen, let me turn on my camera real quick for everybody. I've got a face for radio, I've been told, but nonetheless.
Yeah.
Let me get this turned on. So I'm also a state and local tax partner here at Bennett Thrasher, and I actually started off my career with the Georgia Department of Revenue. So kind of started off in tax policy, and then spent some years in Big Four, and then spent some years in a big law firm litigating state and local tax cases. And I'm going to talk about some of those cases I litigated as part of this presentation. And so, Stephen, if I could just ask, when you are done with your portion and it's my time, if you could stop sharing your screen, I'll share my slides with everybody at that point. And then when it's Chris's turn, I'll stop sharing my slides as well. So with that,
yeah, Katie, is that? I'm sorry. Yeah, Katie, I was just going to check to see if that's doable in this sort of new virtual world.
Yep, we can do that.
Okay, great. Thank you.
Wonderful.
All right, Chris, do you want to? Yeah, Chris, do you want to introduce yourself?
Hey, yeah, sorry. Took me a minute to get unmuted there. Yeah, so I'm Chris Stevens. I'm a manager in the SALT group. I work with Peter on some controversy stuff and Stephen on some state and local sales tax stuff. So I'm going into my 5th year now of doing this. I'm an attorney by trade. I went to Maryland Law School, got my LLM at Georgetown, and then came back down south where me and my wife are from, and been enjoying working at Bennett Thrasher pretty much ever since. So looking forward to doing this with you guys.
All right, great. So just want to confirm, can you all see my screen, the presentation?
Yes.
Chris or Peter? Okay, thanks. All right, great. So I know the reason that you all joined here is that sales tax issues in the contractor and construction space are way more complex than they should be. And I know Doug mentioned that, getting this sort of mostly accurate or accurate is the goal. And it certainly is. I would say I tend, with my clients, I tend to focus on, okay, what can we get that's materially correct? What material issues do we need to be worrying about, whether it's from working directly with a construction company or a contractor, or working with, a buyer who's looking to buy, such companies. So let's see. Okay. So about us, so Bennett Thrasher, as Doug mentioned, top 100 CPA firm based in Atlanta. This year, actually, very recently, we're chosen as a top 50 construction accounting firm in the country by Construction Executives. And so that was definitely an honor to be chosen and selected. I think it was the first annual that they had done. And Peter and myself and Chris have all introduced ourselves. So just a quick overview here, or agenda. Essentially, we're going to go through all of the sales tax stuff that you all really need to know. And I know I've talked with a number of, whether it's CFOs or controllers or sort of owners, that sales tax in the construction space can keep them up at night. So our goal here is to provide you with some clarity where otherwise it seems like a very sort of unknown subject. So I won't read through all of the agenda items. I can pretty much go to, here's kind of, if I boil down this presentation and Chris and Peter sections as well, really what it's going to get at is there's really 4 things you need to take away. One is that a common sense approach to sales taxes just doesn't work in the construction space. I would say the one potential exception would be if you are a company that's operating in one state and you've been audited in that state, and I would imagine you've had some issues come up in that one state, and you've previously gotten guidance, and you've worked through the kinks of the contractor rules in that particular state, like Georgia or North Carolina or whatever state it is. That would be, I could term that as common sense, and really common sense is not even appropriate there. More so what I mean is if you've been doing sales taxes and you've kind of had to walk through the fire and get your sales taxes correct, and you're not sort of expanding into additional states, then your common sense or your processes as they are may be okay. One other point on that is I know that these presentations sometimes can appear, come off as sort of alarmist, sort of wanting a big call to action. So, just want to clarify, we're going to try to present virtually as your advisors, and again, taking into account materiality and, how big is this issue? If this is a $300 sales tax issue we're talking about, at the end of the day, it's immaterial. So, we'll try to focus on the most material issues that you need to be aware of, and not sort of be alarmist in a sense, but really try to kind of hone you into the right things to focus on. So, second takeaway, one state's rules don't apply to other states, and we'll get into that more. Third takeaway is there are just numerous forms and administrative requirements that just come with sales tax issues in this space, whether it's registration requirements or exemption certificate requirements, or certain forms that need to be obtained from the GC or from someone else. Which really leads to point 4 is sort of, you must have someone focused on sales and use taxes if you're in this space. And it can be, a lot of the clients I work with, they might have a controller or sort of an accounting, like accounts payable, or someone in that department that has sales tax under their umbrella, and we will come in and help advise them. Other companies that we work with, they, the CFO will engage us directly and help them to sort of implement a process and make sure their people are trained on exactly how they need to be handling sales taxes. And then one final point of clarification. So there are sales and use taxes. Those are technically 2 separate taxes. We will get into what those mean in the presentation. If I use them interchangeably, or Peter or Chris, just understand that it's essentially the same tax. It's just who bears the tax. Is it the seller, or is it the purchaser, or the contractor in this case? Okay, so and Katie, just so I'm aware, is there a notification if there are any questions that come up?
I'll definitely see them in the chat section.
Got it. Okay. All right. I'll try to keep tabs on my. Okay, great. Yeah, and y'all please, chat your questions in, and Peter and I and Chris can address those, because we'd like to make this specific to your situation to the extent we can. So first, we're going to start out with just an overview, essentially, of contractor sales taxes and what the general rules are. So in general, if you're a contractor, which we will define, you must pay sales taxes to your vendors when they are charging you for the materials that you're buying. And a contractor, generally speaking, would be someone who is purchasing tangible personal property and is incorporating and permanently affixing sort of that property to construct, alter, repair, or improve real property. So real property contractor, the definitions can get hairy, and we can talk about that later. So step one is, okay, did your vendor charge you sales tax? If yes, then I'm going to say that's a good thing. If no, that's where the use tax comes into play, and that's where when you buy your lumber or rocks or building materials, if the vendor is not charging you sales tax, then technically you are required to self-assess a use tax and report it to the state on your monthly or quarterly filed sales and use tax return. And then labor is typically not subject to sales taxes. So when you charge the owner or the GC or the customer, you will have already paid the sales tax on the materials, and the labor charge is part of your services. You will not charge sales tax to the owner or the GC or whoever at that point. Right. Okay, so yeah, so when generally is a contractor considered to be constructing, et cetera, real property? There's really a kind of three primary tests that we look at. One is really that states look at for sales tax purposes. The first one being, what's the intent of the party? Is the material that's being incorporated intended to be there forever? Is it intended to become a permanent part of the real property? And as we'll see, when it comes to carpet and cabinetry and countertops, the answer depends not on common sense, really, more so on whatever the states have ruled it to be. So what's the intent? That's step number one for determining, do I need to be charging sales tax to the GC or owner, or do I need to pay sales tax to the vendor? So if it's intended to be permanent installation, then you're a contractor in the general sense, and you will pay sales tax to the vendor. Step number two is degree of affixation. So how, when you are installing or incorporating or the tangible personal property, how affixed to the real property is it? Is it a set of blinds that you are hanging up and simple, just kind of screwed into the wall, or is it an elevator that is sort of deep into the in the middle of the building, or some other sort of like ductwork or electrical wiring that you'd have to break down walls in order to get it out. So the degree of affixation. And then the third would be, does it substantially add to the value of or prolong the useful life of the real property? And this test is a little more hazy, but generally speaking, is what you're installing sort of something that's specific to the current occupant? I can't think of an exact example, but for whatever reason, what's coming to my mind is a vending machine that's like, sort of permanently affixed to the wall. That would be, for that specific occupant maybe, and not necessarily for the real property and any future owners. So Peter, I don't know if you have any comments about either of those three tests, but just
I thought I might just jump in with kind of some real world examples that we've collectively run into here, just to add a little color. So here's a great example when you're trying to figure out what you're dealing with. So I had a client that manufactured stone fireplaces, and they used kind of a revolutionary technique that they got from Europe, where they used basically powdered crushed stone and rosins mixed together to create a synthetic stone product. And they generally made fireplace mantles and sometimes kitchen hoods that looked like they were made of granite or marble or what have you. And so the state of North Carolina Oh, and this company sometimes installed the fireplace mantles and sometimes they didn't. And the state of North Carolina came in and said, you know what? These guys had been treating themselves as contractors under the theory that a fireplace mantle is permanently affixed to realty. So they would purchase powdered stone and rosins and other raw materials, pay sales or use tax on those, and then they would fabricate or manufacture the product into a mantle, and then they would either sell it at retail or incorporate it into a job site. And they'd always tax themselves as contractors on jobs where they installed the materials into the property, and they taxed themselves as retailers when they were selling it. So the state of North Carolina came in and said, we don't think fireplace mantles are permanently affixed to realty, which, it's hard to believe they took that position, but we almost went to litigation over this because they claimed that, at the end of the day, these mantles were kind of glued into the house and not, permanently affixed so that you'd have to tear down a wall. It just goes to show, these tests can be fuzzy. We argued that, look, hey, under the intent test, if I buy a house and there's a fireplace mantle sitting there, I expect that to stay with the house. And if the seller leaves with that, I would be very surprised. And then secondly, in terms of degree of affixation, yes, it might not permanently destroy the wall, but, there'd be a big gaping hole where the fireplace mantle was. And so, arguably that's a significant degree of affixation. And finally, in terms of adaptation of the tangible personal property to the value of the house, a house with a fireplace mantle is better than, something with a hole in the wall. So anyway, I just wanted to illustrate that one example. Back to you.
Thanks, Peter. All right. So as I kind of mentioned, one of the takeaways, general rules are sort of marginally helpful. So the three sort of primary tests we just went through is, again, marginally helpful. There is a Hellerstein state tax treatise, which is kind of like the Bible of state taxation. And there's a real estate construction section that just this quote came from that I really enjoyed it. And Hellerstein, who wrote the treatise, just said that the detailed application of these general principles across the states yield widely, some may say wildly diverse results. So it's kind of a tongue twister, but his point is just, you can't just take those general rules and sort of run with it. So just a quick note, why are these rules so complex? And really what happened and where it came from is during the Great Depression, the states started imposing sales taxes to meet the revenue needs. And they just didn't really address contractor issues. They kind of said, sale of tangible personal property is taxable and services are not. And since these kind of fall in the middle, they just they ended up being decided by the courts largely. And so that's where you have all of this variety from the different states. So Peter, Katie, I guess I'll stop sharing my screen here and flip it over to you, Peter.
Great. Let me see if I can share my screen. So just a second here. If I'm not able to, Stephen, you can just go back to share. There we go. All right, stand by. Okay. Sorry, I'm having some difficulty getting the right screen up here. All right. It doesn't look like I'm going to be able to do so. So, Stephen, if you want to go back to sharing your screen, I apologize. I'm unable to do so, but I'll speak from my slides. So
Yeah, sure.
thank you. So to illustrate kind of some of the complexities and perversity of the law related to contracting, I wanted to talk about sometimes it's not even possible to figure out if you're really acting like a contractor. So the generally understood meaning of a contractor is somebody who's permanently incorporating materials into real property, right? Whether it's new construction or capital improvements. And that is in contrast with somebody that is a manufacturer, right? Different tax regime. Somebody that's a manufacturer takes raw materials and fabricates them into a product for sale, doesn't pay any sales tax on the inputs, and then sells those materials, and sales tax is paid on the final sales price. And then finally, there's a third category of people, which is installers of tangible personal property. So if I sell you, let's say, a security camera that maybe is not permanently fixed to your realty, that's a sale at retail. And then if I also install the camera on your property and maybe have a separate charge for the installation, then the installation services are not subject to tax. And meanwhile, the camera, let's say the property, is subject to tax as a retail sale. So where things become kind of confusing is it's not even clear who's a contractor sometimes. So an example of this was the Inglet and Stubbs case. This was a case where an electrical contractor in Georgia was performing contracts in Afghanistan for the U.S. government, which involved installing certain electrical equipment into bases there. And the material was shipped into Georgia. And interestingly, this material was never going to be affixed to realty. It was electrical equipment that would be installed at the base, but was never going to become part of the realty. So the material came to their warehouse here in Georgia, stored for a little bit. They may have repackaged it, and then they sent it back out. And they claimed that they should be able to take the sale for resale exemption, or not the sale for resale, excuse me. They tried to take an exemption because their sales were of tangible personal property to the U.S. government. And Georgia came in and said, nope, you guys are a contractor. And they pointed out a regulation that basically said, hey, you're only a contractor if you're making new construction or improvements to realty. And the Georgia Tax Tribunal, very interestingly, held that, nope, the language of the contractor statute is so broad that it arguably encompasses any issue where there are services and materials are furnished in connection with those services. So notwithstanding the fact that the materials were never going to be incorporated into real estate, they ruled that Inglet and Stubbs was in fact acting as a contractor, and further, and because of that, they were the end users of any and all materials that were going to be installed in Afghanistan. And further, the first use of such materials was in Georgia, notwithstanding the materials showed up in Georgia for about a day and then were shipped outside the country. So once again, just extremely confusing as to who's a contractor and when, and sometimes you can't even rely on Georgia regulations, because in this case, the Department of Revenue disavowed its own regulation, and the court actually let them get away with that and said, hey, the law controls here, notwithstanding reliance on the department's erroneous regulation. Another really complicated issue, as I said, there's these different tax regimes, right? One for manufacturers, one for contractors, and one for installers of tangible personal property. Where things get further complicated is when you have a company that is engaged in both contracting activities, but also fabricating materials for sale at retail. So examples might include an asphalt contractor. There are asphalt contractors that make asphalt, the majority of which they use in road contracts, but they might sell some of that at retail to third parties. And there are multiple examples. The fireplace mantle manufacturer I mentioned before, sometimes they install the fireplace mantles into contracts that they were performing, and other times they sold them at retail. Steel erection and steel fabricators. I'll talk in a little bit about a case I had where there was somebody that fabricated steel beams for erection, and sometimes they sold those beams and at retail, and sometimes they install them into the real property, into a building. For many years, Georgia had a regulation, which is I think still on the books, and also a policy that if you're a contractor, but 20% or more of your sales are from self-manufactured product that you sell at retail, then you are something called a dual operator. And they really kind of hit you with the worst of all possible worlds in terms of kind of mixing these tax regimes. So even though you might be a contractor under their rules, if you had, let's say, 80% of your sales were from contracting and 20% were from retail sales of self-manufactured product, they held that basically you should act like a manufacturer. So even though 80% of your sales are from contracting, you had to pretend you were a manufacturer, which meant that you would buy all your materials that would be fabricated into, let's say, asphalt or countertops or whatever it is. You would buy those exempt from tax like a manufacturer would. And then when you sold a self-fabricated product at retail, you would collect sales tax on the full price of that manufactured product at retail. That's not the controversial part. But the controversial part was for the other 80% of your sales, when you took self-fabricated product and incorporated it into realty, they wanted you to charge yourself sales and use tax as if you were a manufacturer withdrawing product from inventory. So there's this other rule that applies to manufacturers that says, hey, in general, your inventory, the stuff your inputs into your manufacturing is exempt, except for when you withdraw a product from inventory and use it yourself, then you have to collect sales and use tax on the full fair market value of that fabricated product. So applying that rule in this instance, the department said, and the regulation said, if you're a dual operator, then basically anytime you fabricate materials for use in your own contracts, where you're acting as a contractor, rather than just paying sales or use tax on the value of the raw materials like any other contractor would, we want you to pay sales and use tax on the full fabricated value of the product, even though you're the one installing it into the realty. And so this put dual operators at a material disadvantage with other contractors who, as I said, only pay sales and use tax on the raw materials value. So for example, if I were the fireplace company and I was not a dual operator, I would just pay tax on the sand and powdered stone and rosin, which is not a whole lot. On the other hand, if I'm a dual operator, now the department has effectively got me paying sales tax on the fabricated value of the fireplaces, which is much, much higher. So that has been going on for many, many years, and I think is still going on, this uncertainty. So some years ago, I had a case that I litigated with the department about this dual operator issue, and the Department of Revenue kind of repudiated its own approach. And in addition, there's a private letter ruling out there that relates to a steel fabricator that kind of repudiated this approach. So in the department's private ruling, and the case I'm talking about is Oxford Construction Company versus Graham. It was a Fulton County Superior Court case, so it's not binding on anybody else. It wasn't an appellate court level case. But between that case and the private letter ruling that was issued to my steel fabrication client, they've effectively repudiated their old rule. And here's kind of the approach they're taking now. Under their old rule, they looked at, hey, what percentage of your sales were at retail versus from pure contracting? Under the new approach, they said at our urging as taxpayers, the sales tax is a transactional tax. There's no point in looking at what business you're engaged in. It's a transactional tax, so you have to look at each transaction separately. So from that standpoint, it doesn't matter what you do or don't do as a general basis. If you sell something at retail, then treat it like a retail sale. If you use something and that's incorporated into realty, then treat it like a contracting transaction. So instead of the dual operator rule where you should not pay sales or use tax on materials and only charge sales tax at retail or when you withdraw products from inventory for use in your own contracts, under the new rule, you would probably pay sales or use tax on all your purchases of raw materials. And then when you occasionally incorporate those into fabricated materials that you're selling at retail, you would have overpaid sales tax on those raw materials, right? But then you would take a credit or a refund against those overpaid taxes. But for the rest of your sales, when you're acting like a contractor, you would only owe sales or use tax on the cost price of the raw materials, not the fabricated value of the product. So although Georgia has sort of repudiated its regulations and prior approach, I don't think this is widely known. So there's probably a lot of companies still doing this wrong. And other states take this approach as well based on very, I would say, unsettled law. So Florida, for example, takes a similar approach based on its regulations. And there are other states that kind of take this full fabricated value method, which usually is fairly contrary to the statutes, because most states have kind of vanilla contractor statutes that say, hey, a contractor is deemed to be the end user of any and all materials incorporated into real estate. So I think this just illustrates the complexity and the fact that sometimes you really can't even rely on state regulations defining A, who's a contractor, or B, how mixed use operators should collect their sales and use taxes. So with that, I'll kick it back over to you, Stephen, and I don't think I'm sharing my screen, so back.
Yeah, I got it. Yeah, so yeah, thank you, Peter. It's super helpful. Just to restate, essentially, there's an opportunity here that if you are a dual operator and you're charging sales tax on the retail sales price, essentially, there's an opportunity potentially for a refund depending on how you're paying sales tax to the vendor. So I know sometimes when I'm working virtually, I might sort of be doing one thing and listening to another. So just wanted to restate that kind of main point there. All right, so and then Chris, I'll kick it over to you if you want to talk about manufacturing exemptions and
Yeah,
and your slides.
All right, let me see here. There we go. Turn my camera on while I'm presenting. I could let you guys be the only one. Plus, it's probably the first time Peter and Stephen have seen me in like, I don't even know how long since we're all remote. So here, I give you guys that.
Long time.
Yeah. So yeah, I just wanted to talk about manufacturing exemptions and other types of sales tax exemptions that might be available. Basically, most states provide a sales tax exemption for tangible personal property that's used in manufacturing. So that's always an opportunity there where, as Stephen and Peter mentioned, you're going to get charged sales tax, or you should be getting charged sales tax when you purchase things. But if it's going to be used in manufacturing, you should check into whether there's an exemption. One kind of example I just wanted to give, because it's interesting and there could be an opportunity there, is Georgia's manufacturing exemption. I was working with a client. They're a solar company. Basically they're a dual operator, like Peter was just talking about. They make solar panels. They sell some of them, but then they also install some of them. So what they were doing is they operate out of New York, and for whatever reason, as part of the financing, the solar panels had to be shipped to Georgia and stored here in Georgia. I have no idea why, but they had to be stored here. And so because Georgia is the first use state and we don't have a temporary storage exemption, Georgia was going to take the position that the solar panels are taxable here in Georgia while they're being stored. And then when they go to the job in New York, they're going to be taxable in New York as well. New York would take that position. And so we started looking into it, and we had really two issues. Number one, I wanted to see, as I was reading the Georgia manufacturing exemption statute, it says that it has to be machinery that's used in a manufacturing facility and then has to be integral to that process. As I was reading it, I was noticing that it didn't say that it has to be used in a manufacturing facility in Georgia. And I think everybody just assumed, and I did at first, that, well, why would Georgia allow an exemption for manufacturing outside of Georgia? The whole point is to incentivize manufacturing in Georgia. And so as I got to looking at it, I was like, well, their statute doesn't specify it. So I was kind of taking the position that they kind of have to live with their words. They made a statute that doesn't specify that it has to be.
Chris cut out. or is that just me?
I think we've lost Chris for a second. Let's give him a second to come back. Otherwise, I can continue with manufacturing, or you can. I'm going to jump in with an anecdote here.
Yeah, go ahead.
Time. So, as part of one of the cases that's come up a lot is can contractors claim the manufacturing exemption? And the answer is yes. So once again, this is a confusing issue. For years, the Georgia Department of Revenue took the position that unless you were a dual operator and collecting tax like they wanted dual operators to do, you could not claim the manufacturing exemption. So in the Oxford case, I had an asphalt contractor who did not meet the definition of a dual operator. And so the department said, hey, all the manufacturing equipment you bought to manufacture asphalt, you can't claim an exemption for that machinery under the manufacturing machinery exemption. And we noted that the statute doesn't require that you be in the business of manufacturing. All the statute requires is that you use the material in manufacturing property. So that was a case that came out the right way. So I think Chris is back. I'll turn it back over to you, Chris.
No, sorry about that, guys. That's the dangers of remote working, I guess. Getting disconnected at the wrong time. So yeah, where I was going with that was that basically we had a solar company. They were installing stuff. They were having stuff shipped to Georgia to try to get them out of tax. The statute doesn't specify that the property has to be manufactured in Georgia. It only specifies that it has to be used, integral to manufacturing, used in manufacturing. So I took the position and I got a private letter ruling that, number one, that solar panels qualify as manufacturing, number one. And number two, that I did confirm that the manufacturing doesn't have to take place in Georgia. So they ended up being able to exempt the property being stored in Georgia and used in manufacturing out of state. And it's just one of those issues that I wanted to highlight because it's something where you could easily just assume that it has to be used here, but that may not necessarily be the case. It likely depends on the specifics of the situation, but I just wanted to highlight that because it was an interesting one that was a little counterintuitive to me when I saw it. And the other thing to note there too is they could have, because there's other types of exemptions, there's resale exemptions, and the same contractor, when they got the property shipped to Georgia, just note they could have resold that to a related entity out of state who then installed the property. We looked at structuring it that way, and just because of the way their financing worked, they couldn't do it. That potentially would have been another avenue they could have chased down for an exemption that we could have done for them. So just wanted to highlight that. So yeah, in addition to the manufacturing exemption, as I was just saying, there's other types of exemptions as well, sales for resale. So there's times you can structure things in a certain way where, like I was just saying, you could buy a property and instead of installing it yourself, maybe there's an opportunity to sell it to a related party and have them install it. That way you get a sale for resale. You can kind of bifurcate the tax a little bit. There's also exemptions for nonprofit entities if you're selling to a nonprofit entity. Government agencies, things like that. That's pretty common. The real thing I wanted to get to with exemptions on this slide is something that I see come up a lot, which is where the issue of if one party has an exemption, does that exemption flow to the other party? And where I see this happen is a general contractor has an exemption, say a manufacturing exemption, and then they want to give that exemption to the subcontractor to use as well. And an interesting thing to note there is that just over half the states don't actually permit you to do that. And I've seen it happen. I've had some subcontractors come to me and say, hey, we're doing this job. I had a client in South Carolina doing one where basically they said, hey, we have this, we're being a subcontractor for this general contractor. The general contractor gave us their exemption certificate and said we can use this for all of our purchases. Is that accurate? And to them, it didn't sound accurate. It didn't sound right, but they just didn't want to upset that relationship with the general contractor because they work with them so often. So they were feeling pressured to go ahead and use it because they didn't want to question the general contractor, but then they didn't want to be on the hook for the tax if that wasn't proper. And so that was a way where they could kind of use us to sort of be the bad guy and say, hey, this isn't actually allowed in this case, which kept them off the hook for sales tax without upsetting that relationship with the general contractor. So it ended up working out really well for them. But just to make it clear, half the states don't allow that to happen. So the subcontractor had to go get their own exemption certificate in that situation to be able to use it. The other thing to notice is that there's times where even if they could flow it through, sometimes those exemptions could be specific to certain activities like manufacturing, so then you couldn't use it for things that aren't manufacturing. There's times when the exemption could be specific to a certain job. Like there was one in South Carolina I ran into with a mining company where they had an exemption that was specific. South Carolina had some exemption where it was specific to mining operations. I guess they had some big mining job probably that was going to go on, and so South Carolina gave an exemption, like a carve out of that specific mines. It was going to be really beneficial for the state. And so, but it turned out that they turned around and used that exemption pretty much for everything they did, which they weren't really supposed to be doing. And so, but I do see that a lot where, honestly, you'll see companies where they'll get an exemption for manufacturing and then they'll buy office supplies from Costco with it, so you definitely shouldn't be doing that. So I just want to highlight that. I think that's all I got on that slide, Stephen.
Yeah. And Chris, we can probably push through these 2 slides here.
Sure.
And go to the audit defense if that works for you, just timing wise.
Yeah, sounds good. Yeah, and also you'd already touched on all the use tax stuff. I was thinking about that. You'd already touched on that in the beginning, so that's good. And just talking about all the things we're talking about, use tax, sales tax, the exemptions. The big thing about all of this is that states audit this stuff a lot, and the amounts due can really add up pretty quickly. And so, for example, I'm handling an audit defense for a construction company in Florida where they asked them to self-assess use tax. And so they have all these vendors where the vendors didn't charge them sales tax, and they just didn't realize that they had to pay use tax, the corresponding tax. And so, as Stephen said earlier, the best case scenario is your vendors just charge you sales tax, and then you just maintain records of that, the invoices, and you don't have to worry about it as long as you're keeping the records. But if they're not charging you sales tax, the main thing to know is if it's a taxable product, then you should be accruing and paying use tax in the state. I also wanted to highlight that, these audits, they focus on a variety of different things. So you want to make sure you're not just focused on whether you paid sales tax. You should be looking at whether you paid sales tax at the time you purchased from your vendors. If you didn't, did you pay use tax? If none of those happened, was the product taxable? Because maybe it wasn't taxable and you don't have to pay anything. I've also seen them they look at, clients often get surprised sometimes. They'll look at your fixed assets, see what kind of assets you placed in service to see if any of those were taxable, if tax should have been paid. Those are pretty common things. You just really want, and also your exemption certificates, if you are using anything, you just want to make sure that you're using it for the right items, the right situations like I just talked about. Make sure you're maintaining all those records, because that will come up a lot on audit. And on the use tax side, individuals often get away with not paying use tax. What I really run into with companies is, they buy something online, you don't pay, they don't charge you sales tax. Almost nobody goes back and pays use tax. But for companies, you can't really get away with that because it will come up on audit if you get audited. So make sure you're keeping track of that, basically. And that's something we do all the time. So.
Hey guys, we had a quick
Thanks,
question that was submitted.
Yeah, sure.
Angela asked, what if an owner has an exemption that they issue to the general contractor? Would the same rules apply?
Yeah, I'm happy to take that one, or Chris.
Yeah, you guys do.
Yeah, so this is interesting in the sales tax space where the exemption certificate is held by the owner. Like typically I'll see it for like a government, like maybe a city. They will issue the exemption certificate to the GC. But that, as Chris mentioned, that can't flow through to, like, so when the GC makes purchases from other vendors, unless the exemption certificate is in the name of the GC, then they actually can't make tax exempt purchases from those vendors, depending on the state. And I know, Chris, you had said, about half of the states kind of allow that to pass through. I have a slide on that a little bit later. The sort of long story short, I guess, is you have to just look at the state or city specific requirements on how to go about passing through an exemption certificate or whether there's a separate process that has to be done. So thanks for that question. And I know timing wise, to the extent that you all have anything that you were wanting us to cover, or that's something that's specific to your company, please, chat that in. So that way we can, address it specifically. So the remainder of the presentation really is, I want to roll through it and cover sort of a lot of material. Sorry, this keeps skipping ahead. And if something sort of sticks out at you, then again, chat in your question. These rules are so complex that it's difficult to kind of get into every single one of them. So I wanted to talk about definitions from a multi-state standpoint, because definitions can change the taxable implications for what you're doing. So, for example, in North Carolina, you are a real property contractor if you're kind of a more typical construction, building. But instead of a dual operator, as Peter mentioned in Georgia, they have a retailer contractor, or you can be a subcontractor. And some of these states have specific registration requirements, depending on sort of what you fall under. So Pennsylvania, just moving along, the type of work being performed can impact the taxability. So Pennsylvania, they have this sort of unique distinction between what they deem to be construction activities and sales activities. And the DOR, and you'll see this in a lot of states where the DOR, they will, some poor soul at the Department of Revenue is having to list, hundreds of different activities that that they sort of arbitrarily define as construction activities or sales activities. So, for example, they have Pennsylvania has defined, installation of a wall AC as a construction activity, i.e., the contractor will pay tax on the purchase of the material when they buy it. But a window AC would be considered a sales activity, i.e., the contractor is required to tax the owner on the sale of the materials. And I thought this was interesting. There was a case that went all the way to the Pennsylvania Supreme Court on whether the installation of a clock and master sound system was considered construction activity or sales activity. And I just kind of thought that was interesting. At the end of the day, it ended up being taxable to the owner, so it was a sales activity. So the contractor that installed the master surround system and sound system and the clock, which I don't know why the clock was specifically, itemized, but it was taxable to the owner, so the contractor in charge of the tax there. So fixtures versus materials. So in California, for example, the state has defined what is considered fixtures that the contractor installs on behalf of the owner or for the owner. And in California, they define fixtures to include such things as burglar alarm systems and furnaces and boilers. And in California, you would actually charge sales tax to the owner, and if you're installing those fixtures. Interestingly, Pennsylvania treats those same three examples as taxable to the contractor. So the exact opposite, essentially. And then again, going back to California, they define materials to be things that you would traditionally think of as materials, like bricks, lumber, and steel. And really here, this California Court of Appeals court, I thought it was interesting that the Court of Appeals is basically just kind of, admitting very straightforwardly that it's really hard to try to make this determination of what is a fixture and what is a material. And so basically they're saying it's okay if the Department of Revenue just sort of arbitrarily administers and sort of parts the seas, I guess, between what's a fixture and materials, and it's every contractor's job to go out and read those rules. So in a number of other states, a fixture is really something that's permanently affixed to realty. Again, that primarily benefits the business conducted by the occupant and not to the realty. So here's essentially additional factors that may affect taxability. The customer type. I would imagine on this call, there's a lot of you that will build buildings or will erect structures or perform parts of contracts for exempt entities. And so I'll get into the administrative part of that in a little bit. The type of contract / invoicing that's actually done can change the taxability. So for example, if you're installing carpet in Maryland, if you are using a lump sum price, meaning you charge the owner one price, then carpet installation, the labor itself, in addition to the materials, are taxable. But if you split out the labor and materials, just simply separately stating them on the invoice, then the labor is not subject to sales tax. Only the materials, in the sense of you have to charge the owner. So Florida has an interesting rule, and Peter mentioned this earlier. If the contractor is using a lump sum, cost plus, fixed fee, guaranteed price, any of those types of contracts, then the contractor pays the sales tax. And Florida defines what each of those types of contracts are. But if the contractor agrees to sell specifically described and itemized materials and supplies at agreed upon price, skipping ahead here, then the customer pays the sales tax. So essentially, this is like a planning opportunity in Florida, to where instead of the contractor buying everything and paying the sales tax, if you have a construction project in Florida for an exempt entity, for example, you can specifically structure the contract and the sales to specifically describe the items and materials so that you would charge sales tax to the owner, or the owner, and if they are an exempt entity, then they're exempt, so you don't have to charge them sales tax. So no one essentially pays sales tax on those materials. And it's just interesting. It went to the Florida Supreme Court, actually, and was upheld. So title, just when does the title transfer to the owner? That can impact the taxability. So there were two separate cases in Missouri. I can summarize them quickly. One was an elevator, with a contractor that was installing elevators, and they retained title until they received final payment. That was in the contract. And a court ruled that is considered the sale of tangible personal property because the contractor still had title after installation. And yet, on the flip side, a company that fabricated and installed wooden cabinets was considered to be a contractor, i.e., they paid the sales tax themselves to the vendors. It's just interesting to me that you can have, even in the same state, you can have elevators be considered the sale of tangible property, and then just wooden cabinets be considered, permanently affixed to realty. So the type of build can also determine or impact the taxability. So North Carolina, I believe New York's this way. If a project is considered a capital improvement to real property, then it's taxable to the contractor. However, in North Carolina, the state will presume that the contractor is not actually installing or providing services under a capital improvement project unless the contractor obtains an affidavit from like the GC or the owner that says, this is a capital improvement. And North Carolina can actually go back and reclassify those sales as repair, maintenance, and installation, which I have a slide on a little bit later. And then method of affixation. So carpet, I know flooring is a can be a particular issue, and my next slide actually touches on the common issues that we see in this space, and flooring is one of them. But in some states, the taxability of carpet installation can hinge on how it's installed. So if it's installed via tax strip, then like in Maryland and I guess it used to be Virginia and some other states, you actually have to charge the owner sales tax on the materials. And but if you're gluing it down, which is I think more common in the sort of commercial space, if it's permanently affixed, then the contractor pays the sales tax there. So here's some common sort of product specific issues that we see. We've already mentioned kitchen countertops, kitchen cabinets. I've mentioned blinds earlier. Crane rental and dumpster rental. So really what's at issue there with the states is, are you renting tangible personal property that would be taxable, or are you renting a service, the service of a crane operator or a dumpster service that comes in every week and picks up dumpsters? Peter, I know you had mentioned something about those two. I don't know if you have any comments on those, or at least maybe the crane.
Yeah, so thanks, Stephen. So the issue on those is I think most states make that determination as to whether you're providing a service or renting equipment based on whether you have to have an operator provided. So, if I rent you a car and you're going to drive it yourself, every state's going to say, well, that's, or a truck that you can drive yourself, they're going to say that's a lease of equipment. On the other hand, if it's a crane and you have to have a special operator with a special license to operate it, they're going to say, a lot of states, that I'm providing a crane service, and therefore it's a service transaction, and I'm the one that's using the crane.
Thanks, Peter. So I know shipping and freight being charged, to the owner, the GC, it depends on the state. Sometimes it depends on how it's invoiced as well, on whether that's taxable or not. Flooring, we've worked with a lot of flooring companies that, again, there's just no common sense. The idea of, I'm going to rip this carpet out and take it with me, as if you're selling, as if the owner would be obtaining some sort of tangible personal property and not some sort of, permanent affixation. It just kind of boggles my mind sometimes. And then construction supplies. And then I wanted to go into 3 states in particular in the Southeast that have just really unique rules that do catch companies off guard quite a bit. And so one of those is Florida. So if you are a Florida fabricator, so I've worked with like countertop fabricators, for example, that fabricate at their own facility the countertops, and then they take those countertops and go to the job site, and they might sort of fabricate or do more to it at the job site, and then install the countertops at the job site. What Florida says is the fabricator must pay sales tax not only on the materials, like the big slabs of granite or whatever, but they also have to self-assess use tax on the fabrication labor. So the labor that goes into fabricating those countertops, for example. And there are very specifically defined costs for what's included, and it can include things like executive compensation, depending on what the executive is doing. So it's Florida. So I mentioned this earlier with North Carolina, taxable. They have this sort of arbitrary classification as repair, maintenance, and installation services. That again, if the contractor doesn't receive an affidavit of capital improvement from the GC or the property owner, then the service that the contractor is providing can be, or in some cases will be, reclassified as a taxable repair, maintenance, and installation, such that the contractor has to charge the owner sales tax on the material and on the labor. And Peter, I know you sort of dealt with this, but North Carolina, they've had these back and forth rules, particularly around, I think, 2016, 2017, maybe into 2018. They just kind of went back and forth on several of those rules.
Yeah, I was just going to say, so I think maybe because of the case that I had with them, they kind of flipped and differentiated between, materials contractors and traditional contractors versus people that are providing kind of ancillary services to real estate. And that's a big issue in a bunch of states. It's what they define as kind of core contracting versus ancillary services can be really, totally random.
All right, and then Mississippi has a contractor's tax that is, I worked with a client that they had a $33 million project that they sort of, had they been aware, they would have charged the owner essentially this 3.6% contractor's tax, but instead they had to pay it out of pocket. And I didn't follow up with them to see if they ended up going and negotiating with the owner, but the Mississippi contractor's tax is a tax on the general contractor. So it's like the general contractor has to go and report this contractor's tax, and the tax is on all gross receipts for the project. And now it doesn't apply to residential buildings, like building homes and things, but it does apply for like commercial type buildings, even including apartments, and over $10,000. And the general contractor can, when they're estimating the project to the owner, they can take their total estimate and then again multiply it by this 1.0362694 in order to essentially incorporate the contractor's tax into the estimate. And
I just wanted to chime in with, there are a couple non-standard states, like New Mexico is a great example. New Mexico imposes its gross receipts tax on contracting. So converse to almost every other state's treatment, the non-conventional states would let the contractor purchase materials exempt from sales and use tax, or gross receipts tax in this case, but then charge tax on the full contract price.
Yeah, thanks, Peter. And similarly, kind of on the Mississippi contractor's tax, there's a materials purchase certificate that's issued by the state that allows the general contractor to issue that to subcontractors and whatnot, so that they can buy materials without paying sales tax, since they're already paying the general contractor's tax. So I'm just going to end it here with administrative issues. And it looks like we got one question here. So let's see. When I manufacture something for a contractor to install, I typically charge Georgia sales tax. Yeah, so I'm reading that. Or Peter, do you want to read that maybe while I'm presenting, and maybe you can answer it? That's
Yeah,
okay.
I'll take a shot. Yeah, I'll take a
Okay,
shot.
thanks.
While you're talking.
All right, appreciate it. Okay, so yeah, so documentation and compliance is very form driven, like literally, form A7538, and just complying with those forms is key. And again, I don't mean to be alarmist by sort of having in bold and underlined must have someone focused on sales and use tax. I get it, that is somewhat alarmist looking, but I've just seen a lot of contractors sort of get burned, and having someone focused on it, even internally, that may not fully understand sales taxes is really much better than just sort of, head in the sand approach, which I definitely understand why, you'd want to take that approach. So Peter, just let me know when you're, if you want to chime in and answer that.
Yeah, so real quick, the question was if this taxpayer manufactures something and then gives it to a contractor to install, and let's say that he was asking basically about the situs of the sale. Let's say you give it to the contractor in Georgia, but the construction site is in South Carolina. Where do you situs that one? And that's a great question. So it depends on the nature of the transaction. So let's say you are the one acting as a contractor because you're ultimately responsible for installation of the property, even though you've got a GC, then Georgia would say you have to pay sales or use tax in Georgia, when you first take possession of the manufactured product. Alternatively, if you're acting as a retailer, then sales of tangible personal property are generally sourced to where the transfer of title or possession occurs. So that would be in South Carolina. Stephen, do you agree with that?
Yeah, and I know Georgia specifically has regulations that, in this kind of an instance, will say it really depends too on the method of delivery, actually. So if they come and pick it up in their truck at your location, then yeah, you charge Georgia sales tax. And but if it's a common carrier and you have knowledge of where the product is going, then you would charge sales tax based on where it's being shipped to. So I think what Georgia and other states try to get at is, where does sort of absolute knowledge of the seller end as far as where this product is going. So if someone comes and picks it up in their truck at your location, then you have no idea where they're going to take it, even if they say South Carolina. So you have to charge Georgia sales tax. But if it's a common carrier situation and you are in charge of the shipping, then and it's being picked up by whoever and mailed to South Carolina, then you would charge South Carolina sales tax, assuming you have you registered for South Carolina sales tax purposes. So yeah, I hope that's clear. Let us know if not. And thanks for the question. And I know it's 12:48. We got 12 minutes left. I want to sort of leave some time for any questions. We're pretty close to done with the presentation. But as I said, yeah, please send in the questions. Okay, got the thank you. All right, tax exempt entity issues. I know Chris had mentioned this before. This example here with the Alabama city, this was a situation I had with a client where essentially it's kind of crazy. Each subcontractor had to apply for the exemption certificate with the city, file monthly returns that were different than sales tax returns. They had to sort of report out kind of what they were selling, what they were doing. And then the subcontractors also had to maintain a listing of all of their vendors who received a copy of the exemption certificate they gave them from the city. And that listing needed to have the name, address, and the type of business the vendor was. It's just kind of wild. So in that same Alabama situation that my client had, they had an exemption certificate from the city, but the exemption certificate didn't apply to all purchases of everything, essentially. And it's kind of easy to be able to fall into that line of thinking if you're selling to an exempt entity. But like consumables, gas to power the subcontractor's equipment, et cetera, those purchases of those types of things wouldn't actually fall under the exemption. So sourcing is just kind of what we just touched on here, where the vendor is, going to charge you sales tax based on where they ship the materials to. But if you're a company that buys inventory and you don't know exactly where you're going to install that, which state or county, you might give the vendor a sale for resale exemption certificate and then need to accrue use tax at the job site. There's some other ways to handle that, but okay. Size of project can trigger additional administrative issues. And then joint liability, the GC and the subcontractor can be held jointly liable. And that really brings us to the end here with a little time for questions. Peter or Chris, do you all have anything else to add?
I would just wrap up by saying, I think the lessons here are the laws are highly variable based on state and based on the particular facts of each transaction. So I think it's important to have somebody within your organization that's really focused on this. And there are a lot of pitfalls. And so, it's a good idea to have somebody focused on this or have an outside advisor focused on the specific issue.
This is Doug.
Yeah,
Guys, thank you so much.
Yeah, go ahead, Doug.
Steve and Peter and Chris, this was great. It's given me a whole new appreciation for the risk behind the curtain of sales and use taxes that my clients are facing every day. So, it was very enlightening, and thank you so much for participating. To all you who are still on the line, be on the lookout. We've got a couple of additional upcoming programs next month. One is a long-term care planning program, and that's on October 7th. And then the second is a program on Medicare Basics, which is October 22nd. And we'll have limited in-person spots available. We've got a very large conference room with plenty of social distance space for those who are comfortable. And then, of course, we'll have a virtual option as well. Thanks so much, and have a great day.
Thanks, everybody.